How's it going, everyone? My name is Amos, and that was literally my pandemic work from home outfit. I used to be formal up top, and then I always wore basketball shorts on the bottom because nobody could see, right, on Zoom. But anyways, very recently, I uploaded 2 videos, the S&P 500 income ETFs and NASDAQ 100 income ETFs. And I broke it down and I talked about which ones are good, which ones are bad. And I told you, I preferred return of capital ROC distributions. Well, in this video, I'm going to explain why ROC is good because it lowers your tax burden. And I think it goes without saying that yield max ETFs are also welcome in this conversation because most of their distributions overwhelmingly are also ROC. So without further ado, let's go ahead and get into it. So it's been a while since I made a teaching video, but I love to do it. To see why ROC makes a ton of sense, especially for us dividend investors, I'm going to be using an imaginary income ETF titled Dude. And we'll go ahead and assume they do a covered call strategy for dividend compounders with cheese. And let's say each share will set you back about $10. So $10 a share. Let me just make this a little pretty right there. $10 a share. And let's say your cup of coffee in the morning tasted phenomenal. So you're feeling it. You buy 100 shares of Dude ETF. That will be $1,000 for your cost basis. Correct? Now let's fast forward and say it's dividend day. Whether this pays out every weekly, every month, doesn't matter. I guess if it makes you feel happy, we'll go ahead and say every week. Now it's Friday and it's payout day. For every share of Dude ETF that you own, you're gonna get $1 of ROC distributions. So the payout, if you do $1 times 100 shares, is what? $100 as your payout in ROC. Now here's the crazy thing about ROC distributions. Because it's ROC, when you get that dividend payment, that distribution into your portfolio, into your brokerage account, it is not taxable right now. Because in the eyes of the government, you're basically getting some of your investment back. Hence why it's called return of capital. At the same time, as you can see by this column right here, your new cost basis is now $900 because your $1,000 cost basis is reduced by the $100 of the ROC that you received. And it's not just a one-time thing. Let's say the next Friday, 7 days later, you also get $1 per share of Dude ETF that you own, which equals to $100. And we'll also assume that the entire $100 payout was ROC, which means now your new cost basis is $800, which takes us to what is the tax situation. So when are you going to pay the taxes if you're not paying the taxes up front for these distributions of $100 right here and $100 the following week? Let's say you have shaky hands and you just don't feel like holding on to a very speculative income ETF because their dividend yield is ridiculous and it's bonkers. I don't blame you. So you sell out of them immediately after receiving your $100 in ROC. Now, mind you, your cost basis is $900. So when you sell out of Dude ETF, you're going to be paying capital gains taxes on the $100. That's it. Now, normally, when you sell for a loss, you can do a tax write-off for about $100. But instead, because your ROC brought down the price per share to $9, you technically have a loss of $0 because it brought your cost basis down. So no tax write-offs. Now, let's assume scenario number 2. Let's say you sell after getting the $100 ROC distribution, and then the following week, the price per share increases. They have share price appreciation because all of the dividend compounders with cheese, the underlying that they're doing the covered call strategy for, they're soaring to the sky. So let's say $12 per share. And when you sell, you're gonna pay the capital gains taxes on the $300. Because your cost basis is $900, you're gonna pay capital gains on the $300 difference. Does that make sense? When I say capital gains, I'm speaking to Americans 0, 15, or 20% bracket. If you're international, if you're from another country, I'm not exactly sure, but here in the US, that is how your ROC income ETFs are going to be treated for the most part. And if we go back to scenario number 1 and you get the $100 distribution on that Friday and it's ROC, As a reminder, you are not going to be taxed on those dividends at all. You will be taxed when you decide to sell out of your position as this cost basis lowers. So as you can see, these high distributions from NEOS, SPYI, or QQQI, or from the yield max ETFs, they're not going to be slapped with the ordinary tax obligation for the most part. For some of us watching this video, those dividends are going to be taxed at like 27%, 29%, 30%. So ROC distributions, when you get them up front, no taxes. When you sell out of them later on, then you pay the capital gains rate, which is pretty stellar to me. And I'm going to show you the breakdown of the distribution classification, what it looks like in the real world with the NEOS, ETFs, and yield max ones here in a little bit. But I think that begs the question, what happens when the ROC turns your cost basis down to zero once you receive back your full investment? And I think that's a really good question. So let's say that dude ETF experiences zero NAV erosion and it continually and consistently stays at $10 per share, and they're able to maintain their absolutely crazy dividend distribution payout of about $1 every single Friday. If this was real, dude, I would put everything into this. And that's why it's an imaginary one, so that we can learn the principles of ROC and the tax obligation. So let's say the next following Friday, they also pay out $100. What's that going to do to your cost basis? It's going to reduce it by another $100. And now your cost basis is $800. And if we continue this on and on and on, and it reduces your cost basis down to zero, then any further ROC distributions that you get will no longer be categorized as ROC. Instead, those distributions are going to be taxed at the capital gains rate, which is kind of like getting a qualified dividend taxed at the long-term capital gains rate. So I'm telling you right now, once dude ETF's cost basis goes down to zero, then any further ROCs are going to have the same exact tax treatment as PepsiCo's dividend, or even Target's 5% dividend yield right now. Dude, they have a 5% dividend yield. They're at their 1-year low. I don't know if they're a buying opportunity or if they're still disgusting. But anyways, their dividends are also going to be qualified and taxed at the capital gains rate, but so will the dude ETF's distributions that are ROC. Now can you see why I prefer ROC distributions? I'm going to be completely honest with you. When I first started doing my research on these high income ETFs, I assumed, like everyone else, that the distributions are going to be taxed at the ordinary tax rate. And to be quite frank with you, the ordinary dividend tax rate is a pretty heavy tax burden. Like if you're married and you make about, like $96,000 a year as a household income, you're going to be taxed 22% for your dividends. And if you make a ton of money and your household income is like, I don't know, $500,000, you're going to be taxed at 32%. Now, don't get me wrong, I am not a CPA, and this is based on my own research and homework, but these income ETFs, like Yield Max and NEOS, to know that their ROC distributions are going to be taxed at 0, 15, 20%, dude, sign me up. That is phenomenal. So I think learning about this really changed my game plan when it comes to these high yield ETFs. It's almost like it's designed to be a long-term hold, because if your cost basis ever gets reduced all the way down to zero from getting ROC distributions week after week or month after month, any further ROC distributions are going to be taxed at this rate. And when you sell, it's also going to be taxed at this rate. So I think that's really good. And I think that changes my strategy, because previously, I think I said on the channel that with the Yield Max ETFs and all of these other high income ETFs, I said they're short-term buy and holds, like maybe reevaluate every week or every month. But after understanding the tax implications, now, please, I am not a financial advisor. This is not financial advice. I am not a CPA. But understanding the benefits of holding on to it long term, I think not a bad deal. And not to mention, if you hold on to that, that Yield Max ETF long enough, and you break even from those distributions with your original cost principal basis, then you're basically going to be playing with house money, despite NAV erosion. Now, I made a video talking about Alti and how long it takes to reach break even. So you should go and watch that video to get caught up to speed. Now, does it always look like that? The example that I gave you of where it's going to be so clean and 100% ROC every week and the share price being stable and consistent? No, it's not always that simple. So now I'm going to show you what it actually looks like in the real world. Which one should we start off with first? YieldMax, NEOS? I guess we'll do NEOS. So what you see on your screen right now is straight from the NEOS website, a look at SPYI's distribution classifications for 2024, return of capital. They give you the definition right here. I think it's worth your time to read it, pause the video and read it. But as you can see right here, in 2024, about 94% of its income distributions were classified as ROC, which means what? The other 6% would have been taxed at the ordinary dividend rate. So 94% ROC, 6% ordinary dividends, as you can see depicted right here. But that was 2024. What about right now? Now, this is from Business Wire, a Berkshire Hathaway company. NEOS Investments announces August 2025 ETF distributions. This was posted in August 22nd. Now, if we scroll on down to take a look at the percentage that was ROC for this month, for their NASDAQ 100 income ETF, QQQI, 100% of their distributions were ROC. And then for SPYI, it was 98%. And it looks like their SPYI was 63%, which means the other 37% were ordinary dividends. And then if we jump on over to the YieldMax ETFs, this is their August 2025 distribution classification. You can see some of their income ETFs and their distributions, like Amazy for Amazon, 54.4% were ROC. The other percentage leading up to 100, ordinary dividends. And if we scroll on down to look at the ones that we care about, like, I don't know, Misty, 74.4% were ROC. And for Alti, 86.9% were ROC. And the remaining were ordinary dividends. So as you can see, the YieldMax and the NEOS, a majority of those distributions, those dividends that you get are ROC and not ordinary dividends that are going to be taxed at a higher rate. This is just the facts, friends and family. I don't want to sound like a broken record, but my takeaway would be this. I know that JP Morgan Chase's income ETFs like JEPI and JEPQ are very popular, but keep in mind, their dividends and distributions are 100% ordinary dividends. So it's going to have unfavorable tax treatment. So unless they're tucked away in a Roth IRA, I would swap them out for the ROC variety if I were invested into JEPI and JEPQ. That's what I personally would do. I'm not recommending anyone to do this. I'm just speaking to myself like I'm crazy in the head. And because I'm talking to myself and now I understand that ROC distributions get better tax treatment, especially in an individual brokerage account, it makes more sense to have them rather than the ones that pay out the exact same dividend yield, but as ordinary dividends. Now, if you want to see the full breakdown of why certain S&P 500 income ETFs and the NASDAQ 100 income ETFs work better, then it would behoove you to watch those videos that I talked about in the introduction of this video. And believe it or not, there's going to be some people that are watching this video that are anti-dividends. There are people that hate watch my content. And if you're one of those individuals, here's what I want to propose to you. Would you ever turn down a salary increase at work because you owe more taxes? Absolutely not, right? Be real with me. Even if you owe more taxes, more money coming into your wallet, that passive income from dividends, you're not gonna say no. Let's be honest with ourselves. And that's why I really like dividends. So despite the taxes and the tax burden and the tax obligations, I still think that dividends are amazing. And that's why dividend growth investing makes up about 90% of my investing strategy, especially if you know which dividend stocks are consistently growing and compound your portfolio while you sleep. Why am I saying that? Because I just uploaded a video that's evaluating, ranking, and grading the Dividend King stocks. Dividend Kings are companies and businesses that have been consistently increasing their dividends for at least 50 years. To be able to increase your dividends in the face of economic downturns, recessions, the dot-com bubble crash, the 2008-2009 financial recession, the 2020 pandemic sell-off and everything, to be able to raise your dividends despite all of those crazy scenarios, I think it goes to show that their business operations are pretty high quality for the most part. If you haven't watched that video, go and check it out. But anyways, what do you think about ROC? Does this change your opinion? Do you like them? Do you hate them? Do you like NEO's SPYI? Do you like YieldMax ETFs? Or are you jumping ship? Let me know. I would love the conversation. And with that, I love you guys. And I mean it. If you engage and you watch the content, you're helping me to do what I love to do, which is to make content on YouTube and to share my passion of the stock market with you guys. So I love you. Stay safe. Good luck in the stock market. And I'll talk to you next time. Peace.